I bought a $500,000 New York Life contract when I was 60. That was nearly 3 years ago. It was 3 years ago in January, actually. That last tranche of income, I want to start 70. By the way, if I'm in a 3% withdrawal rate at age 70, I need $2.8 million generating 3% to take $82,000 a year of income, which is my goal, $82,000 off that tranche. Well, I realized that when I went out and did the quote in January, or actually it was December of 22 that I did this, I realized I didn't need 2.8. Now, to be fair, if you say, well, if I got 10 years to grow the money, but I've got constrained to save withdrawal rates, I can't just chase alpha. What performance would I have to make on a present value today to get to 2.8? So I did the math on 1.8. If I had 1.8, I think I'm going off memory here, but I think 1.8 at 8%, 1.6. 1.6 at 8% without fee grows me to 2.8 in 10 years. Okay. Reality is I didn't need 1.6 either. I only needed $500,000, $500,000 bought me $82,000 in 10 years, guaranteed with installment. It's going to be cash refund to my heirs. Okay. Well, if I didn't need 1.6, I had $1.1 million chase alpha. Yes. In 10 years, where do you think I'm going to have more money? Constraining my portfolio for a safe withdrawal rate of $82,000, or taking $500,000 and carving it off with guarantees?
Yes.
And then chasing alpha on 1.1. Where do you think I'm going to have more money? By the way, if I'm the advisor and I get 4% on the commission, I get 4 years up front of my AUM, plus 1% credit for getting it all up front. That's 5 years worth of AUM all up front. Do I recover taking that 1.1, my AUM, in year 6? No. Do I get it in 7? No. It's minimally sacrificial. How about 8? Nope. 9? Nope. 10? Maybe 10. In the 10th year to 11th year, I'm going to break even where that pile's back at 1.6. And I'm going to, over the next 30, 40 years of that client's retirement, I'm going to make more AUM than I would have ever made than if I would have constrained a portfolio for a safe withdrawal rate in 10 years to get a 2.8. Trust me, we've done the math 16 ways to Sunday. This is not sacrificial. I don't have to do what I used to think I had to do when Joel Szilard told me what a bad idea this was because of revenue.
In other words, do the right thing. You'll actually get paid more in the long run.
In the long run. You got to put yourself on the same side of the table with the client. You got to be willing to sacrifice for a short time what's great for them and great for you. I mean, managing assets where you have no draw requirement out of the pile that's in the market, you can have buffer assets just in case, but you don't even need to use the buffer assets.
Yeah. What's your thoughts on how does life insurance get integrated into this? And I also want to talk about your software. But okay, so you're a big annuity fan. Obviously, you're not anti-investments. How does insurance integrate and make that situation better, or does it?
Well, let me tell you, it starts when they're 18 years old. The one thing I talk about life insurance to advisors that I teach and train my 2-day class, Thrive University, is the best thing to talk to parents about when their kids are graduating from high school is not a shiny new car, new pair of jeans, a pair of Louis Vuitton boots for her. The first thing they talk about to them is buying $1 million of 20, 30-year term life insurance on the 18-year-old. Let me tell you why. You know, when you say that to a client for the first time, there's this knee-jerk reaction, this emotion that says, oh, you think I want to profit on the death of my kid? That's the first thing that comes to mind. You say, no. That's not what I'm talking about. But if I had $1 for every 18-year-old that graduated from high school, who got married, had a mortgage, had kids, and got diabetes, breast cancer, testicular cancer, things that cause them to be uninsurable later. You're not buying this to be wealthy if they die. You're buying this to preserve and protect their future insurability. And of course, you don't go into this at the time you're talking when the kids graduate from high school. But we also know that we're building a base of a convertible product that locks in insurability at a reasonable price for a product they are not going to afford yet. But we're setting the table for what's yet to come, because buying that permanent portion of life insurance as young as possible is where they're going to get the greatest buffer benefit possible for their retirement.